So Peter, we're having these conversations as part of our 30 years in trading investing with Saxo. And if you look at the market 30 years ago, the equity market, the composition is so different than it is today. And we're going to talk today a little bit about the lessons you can learn from that, what the composition is today, what industries are dominant versus 30 years ago, 1992. It's a great starting point, especially for the US market. We're coming out of a pretty modest recession. Europe was also coming into a new phase with reunified Germany and the EU starting to build up. So where would you like to take the conversation in terms of composition then, just before the internet, and the whole upswing around that, and into today?
Yeah, so the start of the 1990s were the perfect starting point for a long-term investor, and it was the beginning of a very, very forceful, powerful long-term trend of digitalization, the internet. And I was quite surprised when I looked at the numbers, so how the different sectors were stacking up. So what is called, defined as the information technology sector was the smallest sector back then. So it was comprised of Intel and some small semiconductor companies, etc. But it was mostly a hardware industry, or sector, if you will. But fast forward 30 years, we've had the internet, the ups and downs, but maturing of business models and the whole digitalization and ecosystem around that. And it's just been such an enormous, powerful earnings engine for the equity market, and it has really now become the biggest sector in the US equity market in the world, and it is twice as large as number 2, which is the healthcare. And it's all been driven by these intangible assets like software and digitalization, and the key reason why equities have done as well as they have, despite 2 massive drawdowns, the dot-com bubble and the great financial crisis.
So you need to take us through what is an intangible versus a tangible, and what does that mean, and why are intangibles supercharging these returns? I mean, we've also seen, compare the returns on the S&P 500 with this slice of the S&P 6 compared to the real returns you've achieved in passive investing in Europe and so on. So what's the big differentiator here?
So prior to 1992, most of the US equity market and the economy was built by tangible assets. So a tangible asset is something that depreciates and is physical. So it's a bridge, it could be a factory, it's a machinery somehow. There are different types of tangible assets, but the intangible assets are something you can't touch and feel. So it's driven by patents. So it can be a patent for a specific drug. It's rights to a different name or music, so that's fueling the whole media. So intangibles, everything that has digitalization and software. And the thing that makes it so powerful is that the return on invested capital is just multiples of what you have on a tangible, physical asset, and that's really been the key driver of equity valuation exploding. And I think the key lesson here is that when you identify a long-term trend, it's important to keep these stocks because they compound. I mean, compounding, Warren Buffett has called it, I think, or maybe it was Charlie Munger, his business partner, called it the 8th wonder of the world. I mean, it's just such a powerful force when it gets going. And I think we have talked a lot about this, John. Right now, we're talking about in our team that the tangible world might be coming back because we need that infrastructure, energy, food, etc., and commodities. And if that really is a long-term trend, the key lesson from the technology trend we have been through is that keep some of these winners for as long as you can, and don't take your returns too fast.
But one thing we haven't discussed, and that I think is so critical, and really has been a critical driver of this rollover we've seen in global markets, is the rise of inflation. And with it, to a degree at least, the rise in bond yields, treasury yields, interest rates in general. What does this do? I think people have a difficult time understanding the impact this has on equities. Why should equities be so sensitive as they are to yields?
Maybe even more importantly, why should technology companies be so sensitive? Because that's what we have seen. It's a really good point, John, because we had the digitalization and the rise of intangibles being one really big force. But what happened as well, sort of midway through 1992 to 2022, was this interest rate cycle changed, and it changed dramatically. And we have had over a decade of falling interest rates. And what it has done is that it has, on top of very fast profit growth for these technology companies, it has turbocharged their equity valuations, because when you when you are a growth company, you are priced based on a very long horizon of growth. So it means that technology companies and growth companies are, have a higher duration. It's a concept we know from fixed income. It basically means that they are more sensitive to interest rates. And it makes sense because the value of a company today is basically all those future cash flows discounted back to today. So the further out you go, the more sensitive today's price is to the interest rates, and that's exactly what is happening. And it's driving a big change among technology companies, because suddenly when money is not free any longer, it puts on constraints that the technology sector hasn't felt for 15 years, really. So they're going through a big transition where it's not an easy ride any longer, and when equity prices are not rising any longer, suddenly you can't reward your employees with stock options. Yes. And it kicks in a negative cycle suddenly. So there is, as you can listen to, you can hear from our conversation, the landscape is almost like tectonic plates. They're shifting underneath the technology companies, and the next 30 years are definitely not going to be as easy as the first 30 years.
Yeah, one of the things you've done, Peter, together with your team is you've created these so-called theme baskets for the equity market, where you're taking a group of equities that obviously have some common theme, whether it's, and the theme could be anything from an industry, let's say alternative medicine, which was of course quite interesting, especially during the pandemic response, but even a valuation theme, if you will. I think it was not very long after you created this bubble stock category that was actually the top of the bubble. So there's all kinds of themes that are operating at any given time in the market, whether for better or worse. What kind of themes, and this is something you can follow with our daily podcast, but what kind of themes do you think you might consider creating in the future, or themes that especially new investors in the market, new traders and investors in the market should be looking for as we sort of are getting a little bit post-bubble, but we haven't necessarily started a new cycle yet?
Yeah. The investor should always be looking for these long-term trends, because then you could get the compounding going. And from the discussion we had, the tangible world is coming back. So some of the themes that we're talking to clients about are the commodities theme. It's absolutely critical because of urbanization, the green transformation, building out of new energy infrastructure. We also like the defense theme, whether we like it or not. The world is coming out of a very long, very peaceful period post the Soviet Union, 30 years of military budgets coming down. We think that pendulum is swinging back, unfortunately, and that will create a very high growth industry among defense companies. So that's a theme as well. Energy storage and renewable energy are two themes that we have created, and going to be super, super important. And I think because of actually the recent US climate and tax deal, there will be a parallel track and bets that can be made. So you can actually still be betting on oil and gas majors for at least for the next 5 to 10 years. That's also what Warren Buffett is sort of betting on, because we need the oil and gas still. But then the renewable energy as part of the energy mix to do this green transformation will be super important. And inside that, you need to deliver energy storage. And then the final very, I think, long-term trajectory and interesting theme, which is a little bit of a spin-off from the digitalization, is cybersecurity. So what had happened as we put the entire world on the internet, we also create a lot of vulnerabilities, and rogue states and hacker groups are exploiting this and attacking companies and government institutions. And we have moved to a point where I think this is very much almost like Microsoft in 1987. We are at the cusp of maybe a 30-year trend where cybersecurity will become almost like Microsoft operating system. It's a necessity to drive and have a company or a government functioning. So that will be a super, super high growth and interesting theme for the future. Deglobalisation, it's a major topic in the decades to come, and there's a job waiting for me there, because we haven't created a deglobalisation basket, but I think it's a basket we need to create at Saxo to provide clients with an inspiration for that. What does it actually mean when you have a deglobalisation? We have a basket on logistics, and there will be. You could argue that deglobalisation means that we'll have less logistics, things moved around. And you can argue that, but on the other hand, what we have seen in the initial phase of deglobalisation is other countries, just like Vietnam and Indonesia, getting a bigger slice of the overall manufacturing production of the world. So there's still things to move around, and you can actually argue that I think deglobalization in the first phase will mean that we'll have less concentration of China producing everything in the world and more countries coming into the arena, and that will mean that we'll have much more fragmented supply chains. So logistics is one, but then the theme I'm thinking about that we have to think about and give clients is that there will be much more shoring of production coming back to Europe and the US, and we have seen that with the US CHIPS Act. There will be lots of opportunities for investors in that regard.
Yeah, even talking about what is the carbon content of a manufactured good as being part of where how it's treated at the border. It's been a very robust discussion around that in Europe for sure. So that's going to be a key part of the fight to do something about the climate as well.